investor coach with SmartPlan. And with me this morning is Jennifer Foster, the investment coordinator of SmartPlan.
Hey guys, we've been doing a series about investors' expectations, and it's really important that investors have a realistic expectation because that's going to determine the success or failure of their investment experience. So if you haven't already seen our video on why am I underperforming the S&P, we ask you to go back and take a look. But basically, investors have been asking some questions basically at the end of last year when they see the S&P was up like 16% and wanted to know why their portfolios didn't look the same. And the simple answer was, well, those are all large companies, and these portfolios that SmartPlan offers through Matson Money have small and value companies. And then we showed the difference of 1 year return versus a 15-year time horizon and saw that it's best to be diversified and not to look at 1 year. Another question where people are asking, of course, when the S&P is up and the international is down is, well, why am I in international stocks? So that's what we're going to take a look at today, because if they have a realistic expectation of how their portfolio is going to perform, again, like referring to the S&P, you have a client who's looking at the S&P and all equity / all stock portfolio versus their portfolio maybe 60% in stocks and 40% in fixed income. They're not comparing apples to apples, and so when they don't have a realistic expectation, they're not going to be happy with their outcome because they're not comparing to the right things. So let's take a look at international stocks and discuss why these portfolios are utilizing them.
And why we should be in international stocks. Kind of reminds me of the late 90s when international was underperforming the U.S. at that time. People were saying the same thing. And then along came 2000 and the tech crash and what have you, and international did very well during that period of time. And then people were wondering, well, why don't I have more international? So it pays to look not just at what's going on in the current year, like 2014, where we see the S&P 500 is up about 13.5%, and international is down in most categories. So let's spread the time horizon a little bit and look from 2000 to 2014, and you can see we get a different picture. That through that time period, instead of 4.24% with the S&P 500, if we look at the small cap and emerging market index, we've got about a 3% more return during that period of time. Well, I can give up 1 year or so of a lower return, knowing that long-term academia has found that small cap and value has outperformed growth and large cap. So, and it holds true both in international and the U.S. We did see in the U.S. slides that the same effect is there. So let's go on through this. Let's see what the dollar amounts are for the time of 2000 through 2014. Well, if we had just had the S&P 500, and keep in mind these are indexes, this is an index of the 500 largest U.S. companies, we'd had $186,482 in comparison to the 100,000 we started with. But if we look at the value index for EFI, which is international, would be 189,513. So we would have gotten a little bit higher return with that index. But look at the emerging markets index, 290,000. Once again, I like the extra 100,000 in both the small and in the emerging market. So it does pay to look at the longer term, not just 1 year. And you don't want to be chasing returns because there's no guarantee that it's going to repeat the next year.
Absolutely, because with the first question that we were talking about, why am I underperforming the S&P? People had this, concern of why their portfolio doesn't look as well as what they're seeing on TV, and then they're like wanting to get out to go to S&P, and what's happened this year? International and most indexes are up.
Correct.
So it does not pay to chase the returns because you're just, and we're going to get into that in just a minute what happens.
There is a world of opportunity in equities, and the United States is not the only game in town. You can see from this the amount of capitalization, or the percent of world market capitalization. The U.S. is 52%, which means there's 48% outside the United States. And this number has gone up because you've seen the S&P increase and what have you, in the United States is doing fairly well. But you can see that 48%, we've got Japan, Germany, Switzerland, United Kingdom, a whole lot of countries in which to invest. So let's take a look at some of the other areas. We have the S&P 500, which is always going to be at the 13.69 for 2014. How about Turkey? Oh, we didn't have many people calling up and asking for more turkey, except maybe around Thanksgiving.
Right.
Israel.
These are just returns for 2014, just a comparison.
Right. And we didn't have many people asking for India or Philippines or Indonesia. And these outperformed the S&P 500 by a considerable margin.
Or Egypt.
So we want to invest in the world. And where are we invested? We're invested in Australia, Austria, Belgium, Brazil, Canada, Chile, China, Colombia, Czech Republic, Denmark, Egypt, Finland, France, Germany, Greece, Hong Kong, Hungary, India, Indonesia, Ireland, Israel, Italy, Japan, Malaysia, Mexico, Netherlands, New Zealand, Norway, Peru, Philippines, Poland, Portugal, Russia, Singapore, South Africa, South Korea, Spain, Sweden, Switzerland, Taiwan, Thailand, Turkey, United Kingdom, and of course, the United States.
Well, I think right now is a good time to address some of these countries that people are seeing they're going into default. And they're like, why would we be invested in these countries if they're going in default? And, how's that going to, play out when it comes to my portfolio? So can we talk about that real quick?
Well, you see countries like Greece that are defaulting on their currency, but it doesn't mean their stock market's not going to give you a good return, because Greece had a good return. In many years when they were having all sorts of bank problems. Why do you get an extra return? Well, there may be more risk in that particular area of the market. So for more risk, investors will seek a higher return.
Right.
So you just got to put up with it. It doesn't mean that all of a sudden your investment's going to go to zero.
Right.
We can't guarantee that what the outcome will be, but historically, if you look at any of the countries that have had trouble, and we do have, I've seen another presentation on that, the countries that have gone into some sort of a financial difficulty and how they return. So,
and really, it's almost just like a little blip.
A little blip.
It's not really anything to write home about. It doesn't really affect the portfolio so much because we're not overweighted to any one country. So it's really not of a grave concern.
Diversification's your buddy. If you happen to have 100% in the country that went down the tubes, that could be a little difficult. But look at where all the problems come up. They're all in fixed income with the monetary policy. If you're diversified in equities, what do you own? You own stocks in companies that are going to continue working, possibly under a different currency or something like that. But you still own the company. You own the assets. You own the receivables. You own the inventory.
The land.
In the land, the buildings. You are a partial owner of all of that. It may get revalued or devalued or whatever, depending on what they do with the currency. But if you're just in fixed income, that can be disastrous.
Like you're going broke safely.
Safely. And inflation's the other enemy. So again, you need to be in equities, in my opinion. So, let's see, from 96 to 2000, looking at a hypothetical statement, the S&P 500 index went up 132%. MSCI Emerging Markets Small Index, negative 49%. Where's the pain? Where's the pleasure? So what would people want to do? I mean, we as human beings do what? We want to move from pain and go to pleasure. We like pleasure. A lot of times we'll even forget the pain in the past, and we always remember the good times, the good returns. But let's say that we moved from MSCI over to S&P 500. And what happened from 2001 to 2005, the next 5-year period? Well, where's the pain now? Seems the pain has moved to the S&P 500 and gone to the MSCI Emerging Markets Small Index, up 162%. So you can see that after the end of the 90s, when international was kind of underperforming or whatever, people were saying, why are we in international? Why? Because look at what happened from 2001 through 2005. That area of the market did very well, and that also helped to offset the pain of what was going on in the U.S.
And in 2000 and 2010 is known for the S&P as a lost decade.
Well, lost decade. But people tend to lose that decade in their mind. And they say, oh, why aren't I all in the S&P 500? Well,
so this
it would have been real great being in it for that 10 years, and that's the only area.
So this is just a great example of why one of the rules that SmartPlan follows is that we do not market time. And that's exactly what market timing means. It means to get in and out of the market and move from one sector to another sector. That's, chasing
the hot stuff.
Yeah. And
we ought to have that song, Hot Stuff.
But what goes up must come down. So you should have been there before.
What you need is a really well-diversified portfolio. This is the aggressive portfolio, and you can tell it's well-diversified, both in international, U.S., and fixed income, with none of the fixed income being longer terms than 5 years. Then that's what you want to have. 12,635 unique holdings in 19 different asset categories in 45 total countries.
Actually, we're up to 46 in 2015. So
things keep changing.
As more countries become free markets, then we'll be adding them to the portfolio. So. But this is what people do.
They blow up that portfolio to say, hey, I want all S&P 500. Or at least that's what they want. But this is why you need a coach to keep you from doing this to your portfolio, from going from 12,000 to 500 unique holdings in one asset category instead of 17.
And just in one country.
One country. You don't want to be there. What you're going to see next are the end notes, the backup and the supporting, for support to these slides. Everything is backed up. We're not making up these numbers and what have you. So if you wanted a copy of the end notes, we can always forward that to you. So just let us know here at SmartPlan Investing, and we will take care of you. Anyway, Jennifer, anything else that you have?
Look, I just tune in for our next webinar. That's going to be why do I need a coach, which we kind of talked about a little bit, but we're going to go into that a little bit more. So go back, watch S&P, and then keep a lookout for our next one, why do I need a coach.